Hugh Young, the Managing Director at Aberdeen Asset Management Asia and a long-time watcher of the Indian IT skies, is with us. Good morning, Hugh. Thank you very much for joining us. First up, your thoughts on Infosys, what you heard from them. Does it hearten you?
I think short term, yes, it does, although for us still the major concerns are really at the management level and whether we're really seeing the proper changes being put in place. Of course, we hope that's going on, but frankly, you won't know for another few quarters. But so far, so good, so we're impressed.
Hugh, hi, good morning, and thank you for joining us this morning. Well, Infosys has guided for a 7 to 9% dollar revenue growth next year, which is still well below what the industry growth has been and what NASSCOM is guiding for. How many quarters or how many years do you think it would take for Infosys to get back to industry-leading growth?
I think that's almost an impossible question to answer. I think the changes being put in place now and that have been put in place for the last 3 or 4 quarters, you should see the effect of those coming in over the next year or two. These things can be slow. When a company has its growth pains, and Infosys has certainly had them, and change is needed, it doesn't come in a quarter or two. It takes a lot longer. That's a human reality.
Oh, well, just a little more in terms of details about the numbers. The management has guided for a 7 to 9% growth in the current year. That's their earnings guidance, revenue guidance. What's your own sense? Are they back at Murthy's game of guiding conservatively? What are you expecting in terms of growth?
Well, we certainly hope that the guidance is conservative, and it would be rather unwise if it were aggressive guidance on the upside, and it risks disappointing. Given the issues Infosys has had, it can't afford to disappoint. So whatever guidance is given, I would have thought has to be at least met, if not exceeded.
How are you approaching the Indian markets now, Hugh? Because so far we've seen, the FI investments of almost $4.5 billion this year into India in hopes of a stable government. From here on, what would your outlook be?
In a funny sense, we're probably a bit contrarian. Yes, the market has had a good run in anticipation of elections. If anything, that makes us a little more cautious, albeit we are very long-term investors, so have had substantial exposure to India in our Asian portfolios for many, many years, and continue to find in India some of the best companies available in Asia. The perennial problems are political problems in India, and to be fair, also the problem currently is one of valuation. In a nation context, India does not stand out as being particularly cheap. If anything, it's at the slightly expensive side.
Okay. I believe you have investments in CMC Limited as well. That one came out with its numbers over the weekend. Did you take a look at them? You have a view?
Yes, again, we don't worry too much about quarterly numbers, although we obviously follow quarterly, and the group as a whole, TCS as well, are doing everything that we expect from them, which is fine. CMC is a little more clunky.
Sure. Just coming back to that point you were making about the market, Hugh, I wanted your view on India. In a sense, do you think that this is a re-rating story in India where something fundamentally has changed, or is it purely a turn in sentiment because of the political trigger?
I think until something actually does change, it has to be one of sentiment. People are very hopeful for what new governments might bring. I'm afraid, if anything, from sheer bitter experience, maybe people should be a little more sanguine and sceptical. We're born skeptics, and we rather hope our skepticism will prove unfounded.
Okay. Well, where are you finding the valuations challenging sectorally in India, and where do you think there is still scope for increase in valuation?
I think as far as valuations are concerned, there's not many areas that are terribly attractive. I guess one area that gives us a little more confidence, although has had a rockier time from earnings point of view, is the cement sector, which has been quite hard hit. Some of the valuations there, after earnings have come under pressure, seem pretty reasonable. But then we look at some of the really great companies in India, whether it be the Unilevers or the HDFCs, and it's hard to say that they're cheap. If anything, they are quite pricey.
So will you be, at this point in time, looking to increase your India exposure in your Asia-Pacific fund? I was looking at your Asia-Pacific equity fund, which is the size of around $2.5 billion, and you have a 5% exposure to India. Will you, at this point, look to increase your India exposure?
No, our exposure to India is greater than that, so you might have missed out a few stocks, but in our Asia-Pacific fund that excludes Japan, we're about 12% in India, which is where we've been for a while. We have been a little higher than that previously. I think with valuations where they are today, we'll stick about the same, so any movements you see from us in India are likely to more reflect our own inflows or outflows, which come into either our emerging market or indeed our Asia-Pacific funds, rather than active investment-driven decisions to buy or sell India. We're happy where we are today.
Actually, that's what I was coming to. How have been the flows positioned, Hugh? We have heard that, I mean, at least we saw numbers, that emerging market funds are once again seeing inflows. What about yours?
I think as far as we're concerned, in common with our competitors and our peer group, we've seen quite large outflows up until recently. So it's probably a little too early to tell whether things have changed for emerging markets. Certainly sentiment a couple of months ago was very, very poor, and we in the industry were seeing substantial outflows, and that's certainly come virtually to a halt short term, and people have got a lot more optimistic. It's funny how they get optimistic after the markets have gone up. They're never optimistic when they're going down.
Okay. No, what you're saying is that the outflows have stopped, but the inflows haven't resumed?
Well, we've had both inflows and outflows. I was saying net outflows have substantially slowed short term. Okay. But that can change tomorrow. They've been very, very volatile, and for a period were virtually constantly negative.
Okay, that's an interesting observation, but that's something that many other experts have been pointing out as well, that net outflows have slowed down. But Hugh, I wanted your view on financials. You have a huge holding in the Indian financial space. 40% is the sector allocation that you have done to financials. What's your view on banks and how investors should approach it?
Well, banking is a difficult industry anywhere. It's arguably particularly difficult in India at the moment, with some of the increasing non-performing loans and certain worries over certain groups. So I think it's very important which banks you invest in. And in our financial exposure, we include companies like HDFC, for example. But alongside that, we do have ICICI, which is a more, if you like, traditional bank, which can come under pressure in a poorly performing loan situation. And then we have a variety of the smaller banks, whether it be ING Vysya or J&K Bank, for example, and HDFC Bank itself, as well as the parent company HDFC. Not an easy time for banks, but providing you stick to the the strongest banks, it should be okay.
So clearly you're not looking at public sector, state-owned banks on a valuation argument.
No, well, you're right. The state-owned banks look on paper by far the cheaper. We don't hold the state-owned banks and have always slightly worried about the quality. So we've stuck with the quality in the sector, but the quality has definitely come at a price. So I'm not arguing that our financial holdings are particularly cheap. But we do sleep relatively well at night with them.
Yeah, that's good to know. Well, I was looking at your industrials exposure as well. Compared to financials, industrials is not too much, about 12%. But now increasingly people are starting to get confident about, capital goods names like L&T, which is up already about 20% this year. What would your view be on how to approach the industrial space and stocks there?
Well, again, it's on a stock-by-stock basis. So we've been, there's certain sectors in many ways we'd like more exposure to conceptually, but if we don't find the stocks we're terribly comfortable, we don't have any exposure, which makes things rather frustrating. So ours are very much driven by individual stocks, not so much by sectors. So every stock we invest in, we've done our own due diligence on and feel pretty comfortable with, and typically hold for many, many years.
So what would these stocks be?
Well, we like things like Grasim still, Ultratech, at that end of the market. Again, consumer plays for us, although not cheap, we still feel comfortable with. So that's the Unilevers, the Godreges of this world.
Mm-hmm. Oh, well, would you churn your IT portfolio, Hugh?
No, we're not. We're not great churners of things. So we've owned Infosys and TCS for many, many years. CMC, Infosys. Again, we've held, I guess, for a good 10 years or so. Do we make adjustments? Yes, we do. So when things go through a difficult patch, as Infosys had, we stuck with it and actually topped it up a little, which with luck turned out to be correct, hoping that the changes would have effect.
Okay. No, you're not thinking of increasing or introducing new stocks like an HCL Tech or a Mindtree into your IT portfolio?
Nothing particularly on our minds at the moment, but of course, if we were just about to do something, I'm afraid I wouldn't be allowed to tell you either.
Okay, we'll keep calling you again to tell us whether you've changed any of your stocks in your portfolio. But since you're best placed to give us a bird's eye view of how the Asian setup is looking, since you have exposure to all of the key Asian markets, for the rest of 2014, how does India feature in the Asian and emerging market basket, and what would the pecking order look like?
Again, from a pure economic growth point of view, India features okay, and not as exciting as it's been. Of course, nobody's that interested in what this year is going to bring. It's really, people are looking at what changes are going to happen as a result of elections and what will happen next year. I think in terms of valuations, which is probably what is driving things, India does look at the higher end of the spectrum on the price level, so not one of the cheapest markets. You could look at China, and you would say that's a very cheap market. But again, it is very much, in one sense, similar to India, or similar to a bit of India, insofar as most of China is state-controlled entities, which trade at fairly low valuations, because often they have obligations to the state rather than obligations to people like us as shareholders. So China is a cheap market on paper, but of course that covers a multitude of sins underneath.
Okay. Okay, just one final check. Actually, I wanted to know what your holding is in GSK at this point in time. I mean, did Aberdeen tender into the open offer?
We did tender stock in the open offer, so we have a far smaller holding. I can't quite remember what the success rate of the tender was, but around 70 or 80% from memory. So our holdings that we'd had for, again, a considerable period are a fraction of what they were before the tender offer.
Okay. Well, finally, Hugh, what, according to you, will be the preference of smart investors globally in terms of equity markets pecking order? Will it continue to remain the US markets and European markets above emerging markets?
Well, the answer is it might well do. I think in rational terms and trying to step back from it, I would say emerging markets are where people should be interested. There is still the long-term argument of the growth that we're seeing and will see across emerging markets. And now it's also backed by valuations. So valuations are some 20% discount to developed markets. So I think for the long-term value-driven investor, which is certainly what we are, emerging markets look as attractive today as they have for quite a while.
All right, Hugh Young, thank you very much for joining us with your thoughts this morning.